What if silver is not moving because traders got excited, but because the monetary system is starting to confess? Well, most people still frame silver the wrong way. They treat it like a side story, a volatile metal, a trader's toy, a Reddit favorite, something that spikes when fear gets loud and falls when the noise fades. But that view misses the real point. Silver does not become explosive only because people suddenly love silver. It becomes explosive when trust in the wider system starts to weaken, and money begins searching for something outside that system. That is why the move in silver matters now. At the end of 2025, global debt reached a record $348 trillion. Government debt alone stood at about $106.7 trillion. In the United States, total public debt outstanding was $79 trillion on February 26, 2026. And the Treasury said it expected to borrow another $574 billion in privately held net marketable debt in the January to March 2026 quarter, followed by $109 billion in the next quarter. That is not a story about one metal. That is a story about a world that survives by issuing more claims on the future. Reuters now adds silver itself. According to the LBMA, silver gained 144, 82% in 2025, and closed the year at 71, $99 after 52. 26% jump in the fourth quarter alone. Then, even after that violent repricing, the Silver Institute still projected a sixth straight annual market deficit for 2026, with demand expected to exceed supply by about 67 million ounces. So the setup is unusual, a metal that already surged in a market that is still structurally tight, while the debt-based system around it keeps demanding more leverage just to keep moving. LBMA. And that brings us to the real question. Why do these moments happen at all? Why do societies that look stable for years suddenly start repricing reality through hard assets? Because the pattern is older than modern finance, older than central banking, older than spreadsheets and policy models. The names change, but the sequence keeps returning. First, a system builds trust, then it exploits that trust, then it stretches itself too far. Then the public slowly realizes the promises are larger than the substance behind them, and when that realization spreads, capital starts moving toward things that cannot be printed, postponed, revised, or politically explained away. Notice what I'm not saying. I'm not saying history repeats perfectly. Rome is not America. Weimar is not the modern dollar system. The 1970s were not 2026. But monetary stress has a rhythm, and that rhythm rhymes across centuries. If you want to understand silver, you have to understand that rhythm. Take Rome. Rome did not begin with monetary chaos. It began with authority, order, and coinage people trusted. But over time, military expansion, administrative costs, and fiscal strain pushed emperors toward debasement. Researchers at the University of Liverpool summarize it simply. Roman emperors repeatedly reduced the silver content of coinage to solve short-term financial problems caused by overspending. By the 3rd century, debasement had become severe enough that silvered, copper-rich coins could still look respectable on the surface while the underlying value kept eroding. That detail matters, because it is the same instinct you see in every overextended system. Preserve the appearance, dilute the substance. University of Liverpool. And once that line is crossed, the damage is rarely just technical. Money is not only an economic tool, it is social trust in portable form. So when a state starts weakening the substance of its money while pretending the symbol is unchanged, it is not just changing the coin. It is spending down credibility. Rome's political story was long and complicated, but its currency told the truth early. When obligations rise faster than discipline, the system starts feeding on the legitimacy that once made it strong. University of Liverpool. Move forward to Weimar Germany, where the same logic accelerated into disaster. Germany did not wake up one morning and decide to destroy its currency for entertainment. The process built through war debt, reparations pressure, political instability, and then the Ruhr crisis in 1923. Instead of absorbing the pain honestly, the state financed resistance and obligations with money creation. Britannica's description is unforgettable because it shows what happens when confidence breaks in real time. By mid-1923, a loaf of bread that cost 20,000 marks in the morning could cost 5,000 by nightfall. And by November 15th, it took 2 trillion marks to buy $1. That is not just inflation. That is the death of money's time function. People stop planning. They start fleeing. Just yelling. Encyclopedia Britannica. Then look at the United States in the late 20th century. Under Bretton Woods, the dollar was not just a currency. It was the center of the global order, with convertibility to gold at the core of its credibility. But by the 1960s, foreign-held dollars had grown beyond the U.S. gold stock needed to support them at the official price. Federal Reserve history is explicit on this point. Persistent balance of payments deficits made the promise harder and harder to keep. So in August 1971, Nixon ended dollar convertibility to gold. That move did not eliminate the contradiction, it exposed it. And when price controls followed, they only slowed inflation temporarily while worsening shortages. By the summer of 1980, U.S. inflation was near 5%. Silver's famous 1980 spike is usually reduced to a speculation story, but speculation was the spark, not the entire pile of fuel. The deeper backdrop was a decade of broken monetary confidence. Federal Reserve history. That is the sequence you need to keep in your head. Trust, overreach, policy improvisation, repricing. Not because every era is identical, but because every era eventually collides with the same limit. You can expand claims faster than real output for a while. You can smooth over the pressure with refinancing, monetary engineering, accounting language, and official reassurance. What you cannot do forever is preserve trust while asking the system to carry more and more promises with less and less underlying discipline. Now come back to the present, because this is where the silver story stops being theoretical. The Institute of International Finance says global debt hit a record $348 trillion at the end of 2025, up almost $29 trillion in 1 year, with governments responsible for more than $10 trillion of that increase. The same IIF analysis said the debt cycle is now being driven less by households and companies and more by persistent fiscal deficits in major economies. That distinction matters. Private borrowing can cool. Public borrowing, once it becomes political habit, is much harder to reverse. And in 2026, mature markets face more than $20 trillion in maturing bonds and loans, while emerging markets face more than $9 trillion in redemptions. This is not just a debt pile. It is a rollover machine. Reuters. The United States sits at the center of that machine. As of February 26, 2026, total public debt outstanding was $79 trillion. Treasury's own financing estimate for the first quarter of 2026 called for another $574 billion in privately held net marketable borrowing, then another $109 billion in the next quarter. Those are not signs of imminent collapse, but they are signs of dependence. A system that must keep issuing at this scale is not standing still. It is constantly negotiating with interest rates, market appetite, and political tolerance. Fiscal data. And here is where the argument gets more interesting. Modern monetary systems do not lose control in the same theatrical way every time. You may not get wheelbarrows of cash. You may get something quieter and more deceptive, refinancing dependency, chronic deficits, rate sensitivity so extreme that every policy move becomes political, and markets that can no longer be separated cleanly from state finance. That is still monetary stress. It just wears a suit instead of a panic. Watch what central banks do when that kind of stress starts building. In 2025, central banks bought 863 tons of gold. That was down from the extraordinary pace of the previous 3 years, but still far above the 2010 to 2021 annual average of 473 tons, according to the World Gold Council. Read that carefully. The institutions closest to the plumbing of the system are still accumulating the one reserve asset that is nobody else's liability. They can call it diversification. The market hears caution. Monitor and World Gold Council. Silver enters this picture from a very different angle than gold, and that is exactly why it becomes dangerous during monetary stress. Gold is the institutionally trusted monetary metal. Silver is the crossover metal. It belongs to both worlds at once. It carries monetary memory, but it is also a real industrial input used in electronics, solar, and other manufacturing applications. Reuters reported this month that even with lower photovoltaic usage per unit and some substitution pressure, the Silver Institute still expects the market to remain in structural deficit in 2026, while physical investment is projected to rise. That dual pressure matters. If monetary demand wakes up at the same time, physical supply stays tight, silver does not have to move politely. Reuters. And that is one of the biggest weaknesses in the usual commentary. People look at silver and ask, is this an industrial story or a monetary story? The honest answer is, that is exactly the wrong question. Silver becomes explosive when those two stories stop being separable. When factories still need the metal, investors start chasing protection, inventories are already being drawn down, and the market itself is relatively small, prices do not glide higher in neat little steps. They jump, they gap, they force attention. That is also why the "this time is different" argument sounds less intelligent the closer you inspect it. Different in what sense? Is the world less indebted? No. Are fiscal deficits vanishing? No. Is the political appetite for real austerity suddenly strong? No. Are reserve managers acting as if paper assets alone are sufficient? The gold buying says otherwise. Is silver entering this period with comfortable supply? Again, no. A sixth straight projected deficit is not abundance. Reuters. Now, to be fair, there are reasonable objections. Silver is volatile. It overshoots in both directions. Industrial demand can weaken in a slowdown. Governments are not powerless. Central banks still have tools. All of that is true. And saying silver has powerful tailwinds is not the same as saying price can only go up in a straight line. It will not. Markets never move that cleanly. But that objection misses the deeper point. The case for silver is not that every month must be bullish. The case is that the structure around silver has become far more fragile than most people want to admit. A highly indebted global system is trying to manage record liabilities, rising refinancing needs, persistent deficits, and growing political pressure, while silver itself sits in a market that has already been running deficits for years. You do not need every variable to be perfect. You only need enough stress for the monetary layer to wake up again. And when that layer wakes up, silver usually moves after gold, but faster. Gold tends to speak first because institutions trust it first. Silver tends to speak louder because smaller markets react harder. That is why silver often feels sudden to the public. By the time everyday investors notice the move, the mechanism has already been running underneath the surface. Central banks rotate, debt grows, issuance builds, physical tightness persists. Confidence erodes by inches, not headlines. Then price does the translating. That is why the smartest way to think about silver is not as a shiny prediction, but as a diagnostic. Silver tells you something about the relationship between paper claims and real scarcity. It tells you something about how much trust the system still commands. It tells you something about whether investors believe future promises will hold their value, as well as officials say. In that sense, silver is less a bet on one commodity and more a referendum on the credibility of the wider order. And here's the part almost nobody likes to hear. Prestige does not cancel arithmetic. Reserve currency status does not repeal monetary history. Technology does not solve the trust problem by magic. Better software does not make excess debt disappear. Faster settlement does not create fiscal discipline. Artificial intelligence cannot turn an overissued promise into a hard asset. Great powers often miss this because privilege delays feedback. The center of the system gets the warning last, not first. That matters for the United States especially. The dollar remains the dominant reserve currency, and Federal Reserve research still describes U.S. financial markets as unmatched in depth and liquidity. None of that changes the core fact that reserve privilege works by extending the runway. It does not remove the runway's end. If anything, the scale of dollar centrality means that when trust does have to adjust, the repricing can be broader, precisely because so much of the world was built on that confidence in the first place. Sluis Fed. Org. So no, the silver story is not really about silver alone. It is about a debt-saturated global order trying to preserve confidence while asking the future to absorb more and more obligations. It is about the tension between infinite claims and finite credibility. It is about what happens when policymakers can postpone consequences but not abolish them. And once you see it that way, the psychology of the next phase becomes easier to understand. First comes dismissal. Silver is irrational. Then comes mockery. It is just a squeeze. Then comes rationalization. Well, maybe industrial demand did it. Then comes urgency. Why is this moving so fast? Then comes hindsight. The signs were obvious. That sequence repeats because the public always wants official confirmation after price has already delivered the message. So what should a serious viewer take from this? Not blind certainty, not metal worship, not the fantasy that one asset solves every problem. Take the lesson instead. Study the structure before you study the chart. Watch debt issuance. Watch refinancing needs. Watch deficits. Watch what central banks accumulate when stress rises. Watch whether silver's physical market keeps tightening even after major price gains. And above all, stop waiting for the same institutions that benefited from the existing order to tell you when that order has become fragile. Because they usually will not. Systems do not send a formal invitation to their own breaking point. They drift, they deny, they refinance, they manage perception. And then one day the thing people dismissed as noise starts moving in a way that no longer feels optional. That is when the public realizes silver was never the story by itself. Silver was the signal. So if you want the cleanest way to frame what is happening, it is this. Silver may be one. https www.reuters.com, business, finance, government. Spending lifts global debt record. 348 trillion 2025 says IOE for 2026 goes 02. 25 says UTM source. ChatGPT. Government spending lifts global debt to a record $348 trillion in 2025 says IAF. https www.lbma.org. UK articles, LBMA Precious Metals, Market Report, Q4 and full year 2025. UTM source docs ChatGPT. Come LBMA Precious Metals Market Report Q4 and full year 2025. HTTPS www Liverpool ASAL UK Archaeology Classics and Egyptology Research Projects Roman UTM source on ChatGPT. Roman silver coin analysis Department of Archaeology HTTPS www.britannica.com place Germany years of crisis 1920-23 UTM source ChatGPT. Germany Weimar Republic hyperinflation reparations HTTPS www Federal Reserve History org essays Bretton Woods created UTM source ChatGPT. Creation of the Bretton Woods system 6 HTTPS fiscal data Treasury Gov and JOS static data published reports DTS daily treasury statement Tauffassungsstudie PDF UTM source ChatGPT. Daily treasury statement fiscal data https www.gold org gold hub research gold demand trends gold demand trends full year 2025 at central banks UTM source ChatGPT. Central banks gold demand trends https www.reuters.com world.china rising investment keep global silver demand steady 2026 Silver Institute and says 2026 is 02 psi 10 UTM source ChatGPT. Rising investment to keep global silver demand steady in 2026 Silver Institute says Mines https www Stiluifed org open vault 2026 Feb West dollar roll as reserve currency UTM source ChatGPT. The US dollar's role as a reserve currency